Two investors start with the same amount of money, and 20 years later, one is making $40,000 a year in dividends without touching a single share. The other has $1 million growth stock portfolio, but has to sell shares every month just to pay the bills. So, which investor is better off? And which strategy actually makes you wealthier, dividend stocks or growth stocks? Today, I'm going to break down how each strategy really works, not just theory, but actual data, the trade-offs Wall Street rarely talks about. And most importantly, I'll share insights on how to structure a portfolio based upon your age and goals and risk tolerance. This way, your investments don't just grow, they actually work for you. By the end of this video, you'll know exactly when growth stocks crush dividends, when dividends actually win, and how to use stock research tools to evaluate both strategies, and why it may be beneficial to own both kinds of stocks just in different ratios. Okay, by the way, I'm Steve Reitmeister, and I've been investing for over 40 years. I was previously the editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen, where I help build a quantitative model to help investors like you quickly find the best stocks. And here's what I've learned in all those years. This isn't about picking sides. It's about choosing a strategy that works for you. Before I keep talking, could you please hit that like button? It helps me greatly. Thanks so much. Okay, let's go. We are going to start with the case for dividend investing. Now, dividend investing is about owning pieces of cash-generating machines that share profits with you quarterly. You get paid just for holding the stock, no work required, no selling necessary. Let me show you a real example using WallStreetZen. Let's pull up a blue chip dividend favorite in Johnson & Johnson. Right here on WallStreetZen quote page, you can see the Johnson & Johnson's current Zen rating. That's our overall grade based on 115 different fundamental factors. And if you look at the component grades below, you can see how well it fares in several key areas. For dividend stocks, I want you to pay attention to three things. First, value. Dividend aristocrats typically score high here because they're reasonably priced relative to earnings. Safety. Mature dividend players often have a good safety rating. And lastly, financials. This tells you if the dividend payout is sustainable in the future. Johnson & Johnson pays $4.14 per share annually right now. And so if you own 100 shares, that's $514 a year you didn't work for. The check just shows up. Again, if you look at the financials component grade, you can get a much better idea of whether or not the payout ratio is sustainable. Johnson & Johnson has a financial rating of B, which is well above average in the top 20% of all stocks we analyze. But this is also a good illustration of why dividends alone shouldn't be the reason to buy a stock. Despite that solid dividend and healthy financials rating, the stock sadly has an overall rating of C and only earns a C for value. That means its future investment potential is average at best. And here again, we want to have the best stocks, not average stocks. As you likely know, all dividend stocks are not created equal. The cream of the crop are called the dividend aristocrats. These are S&P 500 companies that have raised their dividends for 25 consecutive years or more. That's through the 2000 dot-com crash, the 2008 financial crisis, and the 2020 COVID pandemic. They kept raising dividends through it all. Using WallStreetZen, I can easily screen for these companies. I filter for A and B rated stocks overall, high value component grades, and strong financials component grades that show sustainable payout ratios going into the future. Or I can simply hit up the dividend screener. Some examples of the top dividend stocks include household names, Coca-Cola, Procter & Gamble, 3M, McDonald's, and the like. Now let's talk about the metrics you actually need to understand when researching dividend stocks. First up, of course, we're going to talk about the dividend yield. The formula is quite simple. The annual dividend per share divided by the stock price, and then we times it by 100. That last part is just helps you turn it into a percentage. So if a stock pays a $4 dividend and trades at 100, that's a 4% dividend yield. But here's the catch. High yields can actually mean trouble. If a stock starts yielding 8 or 10%, I definitely check the financials grade on WallStreetZen to see if that is sustainable. If it's a D or F, that high yield could be a warning sign. The dividend might not be sustainable. A sweeter spot might be 3 to 5% yield with an A or B rating for financials, right? The second metric is to focus on its payout ratio. This tells you what percentage of a company's earnings goes to dividends. A healthy range is 40 to 60%. If you see 80% or higher, it could be kind of a red flag. Check WallStreetZen's financial grade immediately. And on the flip side, a low payout ratio combined with high growth component grade could point out an even better dividend growth opportunity. Now, here's where dividend investing gets really powerful. DRIP, or dividend reinvestment plans. This is where the math becomes your friend. Let's run a scenario. You invest $10,000 in a dividend stock yielding 4% that also enjoys 6% annual price appreciation over the next 30 years. With DRIP, where dividends automatically buys you more shares, then you end up with closer to $80,000. Without DRIP, it's only about $50,000 that you would likely make. That's a massive advantage for going the DRIP route. Okay, and here's a pro tip. Check the growth component scores on WallStreetZen, even for dividend stocks, because even mature companies can show steady dividend growth. That's what you want. Not just income today, but growing income over time along with a dash of price appreciation. The bottom line, dividend investing is about building an income stream that grows over time without ever having to sell shares. It's cash flow you can count on regardless of what the market is doing. Now let's talk about the case for growth stock investing. Growth stocks often don't pay dividends. You are betting that every dollar the company reinvests in itself increases profitability in the share price down the road. So instead of them paying you dividends, their excess cash typically goes back into R&D, expansion plans, acquisitions, building infrastructure, and the like. Let me show you what WallStreetZen tells us about growth stocks. I'll start by pulling up a stock from our best growth stocks to buy now screener. Now, look at the component grades for one of the top stocks on the list, which is OPFI, a symbol of OPFI. For growth stocks, the growth component grade should be A or B, which means it's in the top 20% of all stocks for these growth characteristics. This is a broad growth measure that goes well beyond just earnings growth into revenue, cash flow, EBITDA, and profit margins. The more consistently the company is growing across these measures and across time, the better it is. Let's look at one of the most popular growth stocks in Amazon. They have been growing for a long time, and the company has returned roughly 15,000% over the past 20 years, meaning that $10,000 invested in 2004 is worth $1.5 million today. Zero dividends received, all price appreciation. But here's what they don't tell you about growth stocks. Things can get really ugly. Like the last bear market in 2022, beloved Amazon tumbles 50%. Tesla was down 60% from peak to trough. Meta was given a 70% thumbs down, and Netflix lost a full 75%. This is where the Zen Ratings earns its keep with growth stocks. During crashes, key grades like momentum, sentiment, safety, and growth can be downgraded, giving you an early warning to head for the hills. The system can help you see the turn before the worst damage happens to the share price. Now, here's the psychological challenge with growth stocks. They can make you wealthy on paper, but they require strong conviction, high risk tolerance, and the right life stage to handle the extra volatility. All right, let's put these strategies head to head with some real numbers. Let's say that you invest $50,000 and hold for 20 years. Which strategy wins? With the growth portfolio, we will assume you invest in something like the NASDAQ 100 or other growth-focused indexes. These have produced 12 to 15% average annual returns over the long haul. So after 20 years, you'd be looking at that initial investment compounding to a range between $480,000 and $820,000, right? Big advancement from that original $50,000 investment. But here's the catch. Your annual dividend income at year 20 might be negligible. To generate $40,000 a year in retirement, you'd have to sell 5 to 7% of your portfolio annually. On top of that, you run a timing risk because what if the market has a serious correction or even a bear market early in retirement? Then these seeming gains get slashed substantially. Now let's review what happens with the dividend portfolio. Let's say you invest in dividend aristocrat stocks. That typically leads to a 10% annual return, about 6% coming from the price appreciation, and then we kick in another 4% from the dividends. After 20 years, you end up with $336,000 to $420,000. Okay, that's lower than growth, right? But your annual dividend income is $20,000 to $25,000 per year, and you don't have to sell a single share. Plus, those dividends typically grow 5 to 7% annually, keeping you well ahead of inflation. Now, let's show these side by side. Total value, growth wins hands down at $650,000 versus $400,000 for the dividend portfolio. Whereas considering just the annual income, of course, dividends wins with the $24,000 versus basically nothing for the growth portfolio. Now, volatility is another win for dividends as they don't swing as much, whereas growth stocks would be quite extreme on this front, especially during corrections and bear markets. And what about the need to sell shares to pay bills? Growth stocks may require that steps, whereas dividend stocks do not. Okay. In both cases, we want to focus on stocks that score overall A and Bs for the Zen ratings. This puts them in the top 20% for their strength of the fundamental profile. But in terms of the component grades, for growth, you're focusing on growth, momentum, and the AI components, whereas for the dividends, you're more focused on value, financials, and safety. All right. Growth wins on the increase in paper wealth. Dividends wins on cash flow. Which matters more? Well, that depends on you. We'll get to that in a minute. Now let's talk about taxes because this is where a lot of people get confused. With growth stocks, you pay no tax until you sell. That's a deferral advantage. When you do sell, long-term capital gains are taxed at 0 or 15 or 20% depending on your income level. You'll also get step-up basis for your heirs, which is a huge advantage for estate planning, and you control when to realize those gains. Now, with dividend stocks, the qualified dividends are taxed the same 0, 15, or 20% rates as the long-term capital gains. But ordinary dividends, like those from REITs, are taxed as regular income, which can have higher tax rates. Now, you're taxed annually whether you need the income or not. Even if you reinvest the dividends, you still owe tax, and you have no deferral control as you do with the growth stocks. So here's the verdict. Qualified dividends and long-term capital gains are tax equivalent. Gross advantage is you pick the timing of when you realize those gains, but if you're in a low tax bracket in retirement, that difference shrinks dramatically. Okay. The bottom line, don't choose your strategy based on taxes alone. Choose based on what you actually need. Okay, let's get into that, which leads to the next point. The best strategy changes as you age, not because the stocks change, because your needs change. Let me break this down by life stage. Ages 20 to 35, this is the maximum growth phase. You're in your 20s or early 30s. Your allocation should likely veer heavily towards growth stocks. Why? You have 30 to 40 years until retirement, so you can better weather crashes. Your job income can cover your living expenses, so you don't need the dividends from your portfolio. Crashes can actually turn out to be buying opportunities for you. And so wealth takes time to compound, right? Then your youth and the long time horizon is your biggest asset. Using WallStreetZen, here's how you'd screen. You first filter for A or B ratings overall. From the Zen ratings, focus on the growth and momentum components. Both should be A or B for the most timely growth stocks. Additionally, consider leaning into the top stocks with the AI factor if you want exposure to emerging trends. Safety should not be as much of a consideration at this age because you have decades to recover from any short-term volatility. Now let's consider investing between the ages of 35 to 50, what is often called the transition phase. Once you hit your 30s to late 40s, you might shift to 70 to 80% growth stocks, and the rest will go into dividend stocks. Why? Retirement is becoming real. You're only 15 to 30 years out. The losses from bear markets cut much deeper now. On WallStreetZen, here's the strategy. You keep your core growth holdings in place, but you start adding quality dividend stocks where value, financials, and safety component grades are all A and B. Screen for stocks that have both growth and value for component grade strength. These can give you the best of both worlds, and that growth element helps fuel future dividend increases. Here's the main benefit. The stability of the dividend stocks makes bear markets more bearable. When you see income continuing, even as stock prices fall, you're less likely to panic and sell at the worst possible moment. Plus, you're starting a healthy habit of starting to live on some of that portfolio income that will become more and more beneficial as you get older. This is transition territory. Start adding dividend exposure through new contributions. Don't sell your growth positions. Let them keep compounding as you still have ample time on the clock before retirement. Now we ratchet up to the ages of 50 to 65, where we are much more mindful of pre-retirement protection. At this stage, we are looking for balance, so likely trim growth to around 50% of the portfolio, and dividend stocks make up the other half. Why? This is the danger zone. You're just 10 to 20 years from retirement. Timing risk is the most dangerous during this period. A 40 to 50% market crash at age 60 can ruin your retirement plans because you don't have time to wait for that many years for a full recovery. You still need growth for inflation protection, but you can't afford the major drawdowns, right? A potential Wall Street strategy here would be look for equal weight value and growth components. The safety component grade also becomes critical. It should ideally be A or B. key. And don't forget to check the financials component, as that is so beneficial for dividend sustainability. Let me be blunt about the 55 to 65 danger zone. If you're 60 years old with 90% growth allocation, the market crashes 50%, you're in serious trouble, brother. You might never recover because you will soon need to start taking income, right? This might delay your retirement plans. Dividends provide an income cushion even when prices crater. That's insurance you need at that age. As we get to ages 65 and beyond, growth should now come down to just 30 to 40% of the portfolio, with a lion's share now going to dividend stocks. Why? Obviously, your primary goal now is a reliable income without depleting principal. Hopefully, you live 20 to 40 more years, so you will need some growth in the portfolio mix, right? But here again, we want to start to overweight the dividends. You can't afford to wait out crashes anymore like you used to. Preservation of capital matters much more at this stage than just maximizing returns. In terms of the Zen ratings, focus heavily on the value, financials, and safety components. All should be A or B. Again, that means top 20% of all stocks we analyze. Make dividend aristocrats a more foundational holding. Screen for dividend growth rate, not just high yield, as you want your dividends to outpace inflation going forward. Your target should be a portfolio generating 4 to 5% dividend yield. So a $500,000 portfolio produces $20,000 to $25,000 a year in income. And those dividends should grow 5 to 7% annually to beat inflation. Your principal stays mostly untouched, continues to grow, and you can pass it to your heirs. Here is the key insight. Your allocation should evolve with your life. What works at 30 years old might be a very painful mistake at 60, and conservative choices made during retirement are fairly unnecessary in your 20s and 30s. Regardless of your current phase, here's something all of you might enjoy. Go ahead and scan the QR code and click the link below to get my new special report, 3 Stocks to Double in the Year Ahead. It's totally free and time to claim your copy. Here's a super important point. You aren't limited to just growth or dividend stocks. You can invest in both. Growth provides capital appreciation. Dividends provide stability and income. Together, they smooth out returns and reduce volatility. Think of it like an all-weather portfolio. In bull markets, the growth stocks lead and your portfolio surges. In bear markets, the dividends cushion the fall and provide income. Psychologically, you always have something working in your favor that keeps you from making emotional and short-sighted decisions when times get tough. If you're interested in building up your portfolio, here are some steps. For the growth allocation, you should filter for overall Zen rating A or B. Growth component should be A or B. Momentum, A and B as well. The AI factor is an optional bonus if you want exposure to timely stocks in emerging industries. For your dividend allocation, you should filter for overall A and B again. Value component should be A or B. Financials is super important, A and B here as well. This ensures that that dividend payout is sustainable and hopefully increases into the future. Safety component should be A or B as well. We want a good night's sleep with these stocks. Then check the actual dividend yield and dividend growth rate on our quote page. Gladly, we also have a service that helps you find the best stocks in both these worlds much, much faster. I'm referring to our Zen Strategy service featuring 11 different portfolios, which narrows down to the top 7 stocks each. And yes, we have a perfectly suited growth strategy as well as an income strategy. You also get a variety of other strategies, including the buy the dip, value, momentum, and our market being AI factor strategy. But I digress. Back to that growth strategy, looking for the top 7 consistently growing companies, not just in earnings, but as I mentioned before, growth of revenue, cash flows, profit margins, and EBITDA. Studies show that companies with these qualities are significantly much more likely to beat earnings, propelling shares much higher in the future. As for the income strategy, it narrows down to the 7 best stocks with the financial strength to pay out even higher dividends in the future. These type of dividend stocks also enjoy a thriving share price. You can learn more about our top growth and income stocks and the full slate of 11 portfolios in the Zen strategies by scanning this QR code or look for the appropriate link in the description below. Now it's time for you to chime in. Which do you identify as a growth investor or a dividend investor? Let me know in the comments section below, along with how you go about picking stocks in those strategies. And if you want to enhance your knowledge of dividend investing, you should run, not walk, to my important video, Demystifying Common Dividend Investing Strategies.